Hi, traders, look trends, risk events, and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. So while I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the standard format. For most of you guys who follow us, then you'll be used to this format where we just check out how markets are trading currently briefly. We'll then look at some of the main themes of the moment, really. So we'll look at just briefly the Japanese election and possible implications for the yen. We'll look at the dollar yen chart while we're doing that. We'll then get into some stocks and the earnings season, of course, in full flight now, with over 100 companies reporting this week, actually, and of course, including a couple of mega cap tech titans. So we'll just run through what are the expectations there and also the charts for Tesla and Google. Before then, just looking at a quick review of last week's main risk event, really the US CPI data. So we'll run through that and the dollar chart. Before then, also touching on some of the UK data, quite important for the Bank of England. And we'll look at cable then, so that's sterling against the dollar. Before then, wrapping up with a preview of the main risk events for this week, aside from those stock earnings. So not too much on the calendar, actually. So the ECB meeting on Thursday, we'll check that out and look at euro dollar. And we'll then look at also the PMI data, which is also on Thursday, mainly Eurozone and UK PMIs, the focus for markets. We'll just run through that as well. I should say, if you do have any questions along the way, please do ask them in the chat box, and we'll try and answer those as best we can as we go. Anything you are looking at or anything we're talking about, I'm talking about, technicals, fundamentals, whatever it is, please do ask questions along the way. More than happy to try and answer anything about, as I say, what I'm talking about or even what you're looking at as well. Okay, markets currently shaping up. Well, Japanese election being at the forefront, really. PM Mashiba vowed to stay on, actually, despite exit polls from the election showing that the ruling coalition has lost its majority. Interesting, APAC stocks really began the week mostly in the green. Markets in Japan, though, do note, were shut for a holiday. EU envoys are set to meet as early as this week to formalise a retaliation plan in the event of a possible no-deal scenario with the US, Bloomberg reporting that. And US equities, well, they are lower. Eurostoxx down around 0.5% now, Eurostoxx 50, after the cash market closed with losses of 0.3% on Friday. Just checking out your US futures, they're in the green, actually, as we look ahead to the start of this week. And the dollar is lower, and the yen is actually outperforming post-election, interestingly. And as I said, we'll get to that shortly. Euro dollar remains on a 116 handle, just checking that. But there's not too much US market moving data actually this week. So interestingly, the dollar might sort of continue to consolidate. It's already had 3 weeks of consolidation, really, just above those multi-year lows. Quiet markets, and you've also got 4% sort of plus funding costs being short dollars. So there is that cost as well, which probably means we track sideways with, unless there is some sort of breaking news, obviously on the trade deal front, really, more than the data side for this week at least. That is possibly the calm before the storm, of course, because we have the FOMC meeting next week. And I think as well, non-farm payrolls on the first Friday of the month as well. I need to double check that. So yeah, it could be much busier next week, of course. Although there is very little priced into that Fed meeting, and we'll get to that shortly. For the yen, and if I just pull up the chart first of all, so bear with me 1 second. So dollar yen, just looking at this chart here, which you can see just take out the consecutive days. So this is dollar yen. And really on this election, then the upper house election it is, remember, markets just digesting that really. As I said, the ruling coalition, lost its majority, although it remains by far, it should be said, the largest political bloc in parliament. The problem, it seems, of course, is that the opposition parties are very splintered and kind of have little chance of coming together as a political force. So going forward, of course, there's this heightened uncertainty, which isn't great. A lot has been priced in, so that's probably why you're seeing dollar yen come off today. And then current PM Ashiba has, as I said, pledged to stay on and try to cut a deal with the US, and that is important. Of course, the trade deal still ongoing, and certainly that sort of possibly helps Ashiba going forward as well. On the flip side, of course, opposition parties might try really to make sort of political hay by pushing for potentially tax cuts to address the cost of living challenges in Japan, and that has weighed on JGBs actually before the election anyway. All sounds kind of yen negative, doesn't it? And then there is the risk that, of course, Ashiba actually steps down as well, potentially then being replaced by somebody like Takaichi, by all accounts, who then wants the Bank of Japan to go slow with rate hikes. So uncertainty ahead for the yen, kind of not clear as well, in a way, why the yen is rallying in many ways today, at least. And as I've said, Japanese financial markets are closed today, so we should get a clearer picture tomorrow, potentially, with those markets reopening after I think it's the Marine Day public holiday today. So interesting sell-off in dollar yen, as I've said, and reasons really why possibly that might reverse going forward. The only thing contrary to that possibly is the fact that if you get a fiscal stimulus, then potentially the BOJ comes into play more with a rate hike, and therefore that is then supporting the yen and seeing dollar yen move lower. Just on the technical side, just briefly, I've just got a question. So I'll run through the technical side of dollar yen. You can see resistance on the black line there, which is 149.59. That's a 200-day moving average. So always a point of interest for markets. And then you've got the halfway point, the midpoint of this sell-off of this year. That's at 149.37 as well. So that should offer some resistance to the upside. It kind of looks like bullish consolidation, although if we do lose probably the 38.2, then that would be the first support level, major support level. You can see it sort of capped the upside previously with a little bit of a spike on a couple of occasions, but that's a 147.13. So that's dollar yen going forward. Oh, excuse me. And just bear with me 1 second. Chat box has been disabled, so bear with me. I'm just had a message actually. The chat box has been disabled, so I'm just typing a message in here just to double check that you guys can all see that. Hopefully you can, because the chat box looks as though it is okay for me. Hopefully everyone can see my message, which I've just sent to everyone. So hopefully that is good for you guys, Sam. Just bear with me 1 second if you can, guys. Okay, strange. Yeah, I can see your question actually. So hopefully, Sam, when you've queried it, I can see your question. So if you do have a question, please do answer it, and I can see that. So hopefully this is all good. And for anyone else, of course, asking or wanting to ask a question. Okay, just moving on then. Hopefully that's okay for everyone now. Yeah, moving away from the yen just to Q2 earnings then. As I've mentioned, we get the market heavyweights, Alphabet and Tesla leading the charge this week, really. So far, Q2 results, they've kind of started to flow in, of course. In general, we've had positive surprises, which are encouraging so far. Of course, we've had record highs in the S&P and NASDAQ. The banks from last week, well, they posted bigger adjusted profit hauls from a year ago, while trading revenues were at record highs on geopolitical volatility, really, for banks. Most expect optimism as well about the investment banking outlook for the rest of the year after deal making rebounded. And if you bear with me, I've got a couple of charts about this. Okay, sorry, bear with me 1 second. Sorry, saying chat box disabled. Very strange because it looks all fine my end. I can only apologize. I can see your message though, Sam. So you can just write something in where you're writing that message, and I will be able to answer your question. Hopefully, that is clear for you. Just moving on, just to a couple of charts, and I've got of the earnings season coming up, of course. As I said, firstly, we get those heavyweights. Just a couple of charts here after the banking, review that I've just done. Just on the left-hand side, you can see, well, we get more than a fifth. So as I said, 104 S&P companies reporting this week. Those Alphabet and Tesla reports are the first of the Magnificent Seven mega caps to release on Wednesday, while results are also due from, well, Coca-Cola tomorrow, IBM on Wednesday, Blackstone, Intel, and Honeywell. Honeywell, often seen as a proxy for the broader industrial economy, they're all on Thursday. And those mega cap tech earnings, Alphabet and Tesla, are after the close on Wednesday. That's the US close. You can just see, yes, some positive surprises then into these first tech titan releases, if you like. That's the chart on the left-hand side, percentage of reported earnings above estimates. You can just see moving higher, nicely positive there. And then on the right-hand side, just highlighting where we are with those Magnificent Seven. They're back to outperforming the broader market that has returned toward performance being highly concentrated again in just a handful of these names once more. And you can just see that with the red line being the Mag 7 performance-wise, and then the blue line being basically large caps, S&P 500, S&P 493, if you like, so X, the Mag 7, and you can just see that outperformance by those 7 stocks. In general, S&P 500 earnings are expected to have climbed 6.5%. So just moving on to this chart in the quarter from the year, the year ago period. That's according to LSEG IBES data as of Wednesday. That would be the 8th consecutive quarter of growth, but if realized well below Q1, which is near 14%, was near 14%, and it will also be the slowest quarterly growth rate since the tail end of 2023. You can just see these are the current earnings estimates for the different sectors, the 6.5% there. It is a chart by Reuters, as you can see. Not sure why the red, the positive outperformance, if you like, is red. But anyway, yeah, 6.5% on the S&P. Energy being the big laggard, and communication services, IT, tech, basically being big outperformance expected. These are expectations once again. Yes, just had a question then, Sam. I got that from yourself about gold analysis for the week. Yes, let me touch upon that just after stocks, actually, if that's good. So just bear with me 1 sec. So I'll just run through then the mega cap tech earnings. And hopefully you've just seen these charts. Sorry, here's the positive earnings surprise that I was talking about, and the outperformance of the Mag 7 on the right hand side, that red line outperforming the S&P 493, if you like. So it's the S&P 500 x those Mag 7. Performance really due to a handful of those mega cap tech titans, and then just this other chart with a 6.5% Q2 earnings expectations for the S&P as a whole. This is, and then big outperformance in the tech and communication services sectors, and big underperformance in energy and a couple of other sectors as well. So just looking just in more detail at just briefly before I get to gold, Tesla. So let me just pull up the chart first of all. Which is here. Obviously, it's had a tough week, volatile year. Sorry, not tough week, not yet. It's had a volatile year, a tough year. Stock down around 12% year to date. Sales have slumped, of course, so that means revenue, margins, and earnings all seen falling sharply with double-digit declines. So analysts expect, just on those expectations, 42 cents per share in earnings. That would be down, I think, around 23% year on year, and that's on 22.7 billion in sales, with revenues seen tanking more than 11%. All down to obviously fading EV market share, stronger competition, and then as well the tarnished sort of brand of Tesla. Loss of EV credit sales have also been a headwind. So really investors, bulls, really Tesla bulls, pinning their hopes on the earnings call, really, it has to be said, with obviously CEO Elon Musk. Hopefully he will be updating on robo-taxis after that launch in Austin, although there have been questions since that sort of positive launch just about safety concerns primarily. So any updates on robo-taxis, on new product launches as well, like the long-promised Model 2, really need to hear about. The latest on FSD, so full self-driving capabilities, also AI initiatives. And then, as I mentioned, actually the impact of the loss of EV credits and how much that will hit the bottom line for Tesla. So all those things really on the call will be key, with expectations obviously for pretty bad financials. Options markets for your guide, they're pricing in around a plus or minus 7.5% move. That would be the day after, so Thursday open. Watch out for that after, of course, the results after the Wednesday close in the US. So 7.5% plus or minus move, options pricing in on the Thursday. Just technicals then, you can see, interesting, we're just sort of trading above now the 200-day and the 50-day. The 50-day is the blue line, and the black line is the 200-day, and the blue line just passed above the 200-day, the 50-day passing above the 200-day, so sort of golden cross, really bullish signal if you do follow that, and just sort of bullish momentum picking up from those lows. We've been trapped in this sort of 360, 280 range for a couple of months now, quite a few weeks. So just moving higher. You can just see I've got fib levels in here. So the 38.2, that's at 319 or so. And then you've got the halfway point of this move lower from that high in December. That was at 488. So you've got the halfway point at 351, which has capped the upside previously. So that'll be a level to note, of course. And then you've got that high from late May at 367. To the downside, then you've probably got 280 or so being a key level, and just above that potentially sort of 288 as well. To the downside. So that's Tesla. Google, let's just look at Alphabet. Pretty positive looking chart at the moment. Their earnings, Alphabet earnings, will be scrutinized for AI monetization, ad growth, and cloud profitability. Those three things probably first and foremost that markets will be looking at. The company forecast to earn $2.42 per share on revenue, approaching just under $80 billion. AI related capex, that is under the spotlight as well, particularly how management positions the Gemini model suite in competition with its peers. Options markets, they imply a sort of 5.7% move up or down. So potentially some meaningful surprises here as well, of course. The stock or technicals for your guide. Yeah, looking fairly positive, looking fairly bullish. You've got probably the next fib level I need to add in here, to be honest. So bear with me 1 second. The minus 78.6 level. So that's around 194.57. Otherwise, you've got the 61.8 of this move down at 183.47, and then below that, the halfway point plus the 200-day moving average around sort of 175, 176. Okay, that's Google. Let's just quickly pull up a gold chart. Bear with me 1 second. Just going to pull up a gold chart. Bear with me. Sorry, just trying to find my gold chart. I actually wrote about gold as well. I'm just checking this. Last Friday on our daily report, just for your guide, which I put out every day after the US close. So conveniently, yeah, wrote about gold then, just for your guide. On the fundamental side, interesting, I think, for gold, sort of stuck in a range at the moment. We'll look at the chart very shortly. But fundamentally, obviously, geopolitical risks, they kind of linger. The global trade war is ongoing, and central bank buying as well continues to underpin sort of longer term support for bullion. China, I know, added to its official gold reserves in June. That was the 8th straight month. And this is this theme of diversification away from the dollar, obviously de-dollarization, which should remain a sort of underpinning support factor for gold going forward. ETF buying, that has cooled in recent weeks after the first half saw strong positive flows. That marked the strongest actual semi-annual performance since the first half of 2020. So there's the sort of fundamental issues around gold. On the technical side, hopefully that's answered some of your questions. Yeah, on the fundamental side, on the technical side, yeah, we're trapped in this range. It's been pretty dull, really, you have to say. You've got the 50-day moving average, which has acted as sort of fairly decent support. And we're just trading above that now and pushing through it, above it quite nicely. That's at 3,323, you can see there. Otherwise, obviously, the all-time high is at 3,500. So I always say the longer we track sideways, and this is a strategy that I have used quite a lot in the past. The longer you track sideways, the smaller the ranges are. If you get longer periods of range contraction, then ultimately the bigger range expansion you will see when something breaks, either to the top side or to the downside. And generally, it should be in line with the long-term trend. Obviously, gold long-term trend is for higher prices. So the longer this tracks sideways, then the bigger the breakout should be to the upside. Obviously, that doesn't work every time. But yeah, interesting how we're tracking sideways, underpinning of support by central banks. ETF buying slowed, but has been decent. And yes, this long-term theme about de-dollarization, of course, is really front and center, at least for us, for the moment. Technicals, yeah, looking good. So 3,500 all-time high. You've got a near-term high from mid-June at 34.52. Support at the 50-day moving average at 33.23. And then you've got the first sort of fib level that we have. Yeah, probably 32.83, which is sort of supported on a few occasions already in May and end of June. Okay, that's gold, or what I've got to say about gold. Hopefully that's helped, Sam. So do let me know, and obviously any other questions, please do ask away. Okay, we'll just move on from that now. Just to US CPI data, important, of course, for the impact of tariffs or potentially tariffs going forward. Just bear with me 1 second. Okay, great stuff. And thanks for the question, obviously, Sam. Okay, going forward, US CPI data, the big data from last week, June, kind of had something for everyone, really, although the dollar did do well afterwards. So the headline, that rose 0.3%. To 3 decimal places. I know some of you will know that we look at 3 decimal places now. It was at 0.287. And that was in line with expectations, but up from the prior month's 0.1%, of course. That took the year-on-year rate to 2.7, which was above the 2.6 consensus and up from the previous 2.4. For core, which is always key for us, key for policymakers, really, those measures were softer with a core month-on-month number rising 0.2%. So 3 decimal places was 0.228, matching forecast, but still accelerating from previous 0.1%. Year on year, then for core, that came in at 2.9%, slightly above the 2.8 prior, but below the 3% consensus. There's a chart actually from an investment bank just with the core numbers again, the month-on-month print. Of course, the blue bar chart, if you like, the orange line is the 3-month annualized rates, so just picking up slightly. And then the year-on-year rate, of course, in the grey, just below 3%. The black line here is 0.17%. We always say this, but this is often say this with CPI. This is a number most economists reckon the core month-on-month number has to hit for inflation to hit the Fed's 2% target over a number of months. And you can just see, we've oscillated around it. It was looking good sort of this time last year, really, and then we picked up above that number, and of course we haven't hit the 2% target at all yet. Again, then lower prints, but now obviously going forward, potentially with tariffs, this may change, and we may be waiting some time to hit that 2% target. As I say, markets were watching for the tariff impact. We did have, a 0.7 increase in core goods CPI. That was actually the fastest monthly rise in nearly 2 years. So it does sort of indicate some impact of levies, but then that was offset, as I said, had something for everything. That was offset by softness in the all-important shelter component. And again, I say this often, that has a roughly 40% weighting, shelter, in the core basket. So that's why we pay attention to rents and shelter. Vehicles as well, new vehicles and used vehicle prices also fell despite fears that this could be a source of inflation in the coming months, given big tariffs basically have been applied to that sector. So interesting report. I know some economists called the data a kind of knockout punch to tariff inflation deniers. And I think one economist, House, basically estimated the core PCE, so that's the Fed's preferred inflation gauge, that will potentially rise to 0.35%, though that will remain subject to some revisions. Going forward, then, concerns remain, of course, as I've said, about price pressures intensifying over the coming months due to inventory stockpiling ahead of tariff implementation. Fed Chair Powell, he previously suggested that tariff-related price impacts could begin only to appear sort of in the August data. I think July, August, September is going to be key then. And if we know, actually, the August data is due September 11th, which is just ahead of the September 17th Fed meeting. So just for you guys, a couple of dates there as well. It all generally, though, supports the Fed's sort of wait and see stance. allowing for more data to come in before the next decision. Obviously, we've got those two sort of Fed officials, Waller and Bauman. They've been on the wires, I think, end of last week, Waller especially, indicating that a July rate cut could be appropriate. They are very much in the minority, though, on the FOMC. Also, just for your guide, two Trump appointees as well. But Chair Powell, of course, in the crosshairs of Donald Trump, well, he's reiterated, Powell, that is, the Fed's willingness, well, to act swiftly if needed, but and it's a big but really, with the resilient labour market and the strong economy, there appears really to be no urgency for a rate cut at the moment, especially if you remember they got it wrong with the transitory call post-pandemic. And that kind of means they may be more mindful, more watchful, more cautious before moving again. Obviously, though, there is that huge political pressure to lower rates and potentially then a new appointee when Powell leaves his position in May next year. I should say, recently just read a very good article. There's so much noise about Powell potentially going, not going, whether he steps down, whether he leaves early ahead of that May date. It's not unusual with other central banks to line up the successor, and that successor be known months before then the current incumbent, if you like, steps down. That is not unusual. It's happened at the Bank of England. It happens at the Bank of Canada, or happened with Carney moving to the Bank of England, for example. And there are other examples of this happening. So it's maybe not as big a deal as obviously some in the media are making out, but something to watch nonetheless. Obviously, Powell's days are numbered because he will be leaving, and we know this for sure, of course, in May in any event. Yes, otherwise, CPI, sorry, just catching up here. Obviously, the caveat is lingering uncertainty around the full impact of those tariffs, and then, of course, the August 1st date as well. That kind of clouds the outlook, and I know that another Fed official recently warned that the latest threat about the August 1st tariffs, new deals, new tariffs coming in, that latest threat could also, I know a Fed official, I think it was Goolsbee, said that could then also delay any potential rate cuts even further. So yes, that's CPI data. If we just pull up the DXY chart now, actually, so this is the dollar index against six of its major trading partners. Always say this again, but the euro is by far the biggest weighting in this index, around 56% or so. So just bear that in mind when you're watching this index. But the dollar, just to blow this up, this was last Tuesday. CPI came out. It had its best day in a month, actually hitting a 3-week high after that inflation data. Markets kind of before the release were basically more dovish, really, and that was backed more by speculation around Trump, obviously, and the pressure he's putting on the FOMC, rather than data, of course, or Powell's communication. So really, we needed a materially cooler than expected inflation print to sort of validate those dovish bets. We didn't get that, of course, and also current economic consensus says, well, there is more to be seen in terms of tariff impact on inflation in the next 3 months. So probably a touch early for major tariff impact. I've touched upon a little bit a few of the components for goods, which did rise, but certainly there will be huge focus on the next 3 CPI reports going forward. Markets-wise, and for the Fed, just before we get to the DXY and technicals, there's very, very little priced into this July meeting next week, around 1-2 basis points. But there is around 16, I think 16 basis points priced in for September at the moment. So that's around a sort of 65% chance or so, 2 and 3 chance of a 25 basis point cut in September. Interesting, though, of course, with the Fed over the summer as well, whether they want even more time, as I've said, to look at the inflation data, and whether then we only get that rate cut if sort of jobs data does capitulate ahead, and obviously non-farm payrolls will be key amongst that. Just for your guide as well, this week we are in blackout period ahead of next week's FOMC meeting, so we will not be hearing from any Fed officials. DXY chart then, blue line again, is important in quite a few majors actually. That's the 50-day moving average. That's a 98.63. So that's capped the upside. You can see on a number of occasions this year already. So decent resistance. So if we do roll over, then potentially we go down. Obviously, key would be these multi-year lows at 96.37. And if I just pull this back a bit, this dotted line here is a long-term trend line, upward trend line from those lows in 2011, actually touched that low in 2021 as well. And then we're just on that now, or we were, sorry, at the start of July with that multi-year low. So that would be very interesting and key support potentially. You can just see I have kept this descending channel in here, bear channel if you like, series of lower lows, lower highs, but we did break out of it, of course. And so probably is negated slightly, although interesting to see whether we roll over or not. Otherwise, upside, if we do possibly move up above that 50-day moving average, then I've kept in here a swing low from July 2023. That's at 99.57 as a potential resistance above. Okay, that's the dollar. Just briefly then as well, we had UK CPI data and also wage growth data out, employment data out of the UK last week. Just quickly, just moving on to cable here. That release, well, it came in, the CPI data in the UK came in higher than expected, both the headline and core. 3.6 headline versus 3.4 expected and previous. Core was 3.7 versus 3.5% previous and expected. Services metric, that is key for the MPC, the Bank of England, that stayed at 4.7 versus expectations of cooling. Interesting really that, because it's kept elevated by price increases that are kind of backwards looking. If you're in the UK, then we've had April road tax rises and rents. And they're really set to dip quite sharply next spring, as much of the services basket only resets once per year in April. So we could be sticky up until that point, but then around that point, really will be expectations for services inflation dipping quite sharply, and then that bringing down core inflation and then headline inflation as well. Bottom line, though, kind of data set a higher bar, if you like, for faster rate cuts going into that data. Many were hoping we may get or see a pickup in rate cuts from the Bank of England from their current speed, their cadence, if you like, of quarterly rate cuts, and hoping for sort of possibly quicker than those at their meetings. But yeah, this data probably reined in those bets. And certainly with headline close to 4%, that means, and I think it's economist Pill, he has said that that means inflation could become more entrenched. We also had jobs data as well last week out of the UK. We had a big upward revision to May's payroll data, and we also had an upward surprise in wage growth. Again, that means we won't get faster rate cuts. But the market is still pricing in one pretty much full 25 basis point cut for the next meeting in August in a few weeks' time. Expectations for easing by year end did ease slightly as well, and it did give a very small lift to sterling, but you can just see how we've rolled over slightly. But we have found support around this fib level. 133.86, that is the 23.6 of this move higher. I've also got in here the high from September of last year. That's a 134.34. Cap the upside, you can see there, and now has sort of acted as support. So interesting sort of area there of support. You've got the 50-day moving average now that we're below. As I said, interesting for a few majors. This has been quite an important Indicator that's at 135.09, so that possible resistance there having turned support. And then obviously you've got that multi-year high at 137.84. Okay, moving on to this week's main events. Just checking now. Yeah, we've got the ECB meeting and the PMI data. We'll just go to this ECB chart first of all. Expectations really are for the ECB to stand pat, basically to pause after 8 straight rate cuts. You can see there going from 4% down to 2% where we are currently. Thursday, probably see them sit on their hands, as I said, and keep rates at 2%. That follows on from the June meeting where, yeah, the Governing Council delivered another 25 basis point reduction. Lagarde at that point, President Lagarde, that is, she noted that policy was well positioned to navigate the current uncertainties, and with the ECB at or near the end of its current cutting cycle, as basically policy rate now lies within the ECB's estimated 1.75 to 2.25 neutral rate range. That is important really for guidance potentially going forward as well. Obviously, the greatest source of uncertainty stems from the ongoing trade frictions between the EU and both sides trying to broker a deal essentially ahead of that August 1st deadline. That would then possibly see US impose a 30% tariff on EU goods, and then the EU likely responding with its own countermeasures. So expect a lot of headlines potentially going forward into that August 1st deadline about what the EU may do, and then some possible coming together and kind of agreement. Obviously, those fears, though, are weighing on the growth outlook in the Eurozone. But then we've had, allied with the appreciation in the euro this year, that's kind of stoked concerns that the ECB could possibly undershoot its 2% inflation target. Euro policymakers, well, they have commented on the euro as well. So do we get anything from Lagarde? Maybe, maybe not. Are very unlikely to explicitly talk down the currency. I know sort of 120 has been a sort of possible line in the sand for most ECB officials, but we're not really there yet. Reporting ahead of the meeting, we always get that sources and other officials. They've suggested that the Governing Council may discuss a more negative scenario on Thursday than previously envisaged in June, after, of course, Trump's latest tariff threat, but kind of remains contingent on the actual outcome of the trade war. Markets really not rushing to adjust then expectations of ECB easing for this year. I think one more rate cut is seen, 25 basis point rate cut, that is, by year end. But the timing is uncertain. With September move probably, well, not probably, it's round a coin toss at the moment. So 50-50 on whether they go in September or later on in the year. Yeah, bottom line then, wait and see stance by the ECB, really. They need to wait for tariff talks to conclude before deciding their next step. We'll probably hear about the meeting by meeting language, maybe some heated debate. But they will be on hold until those tariff uncertainties clear up. If we just pull up then euro dollar chart. Which is here, and you can just see, yeah, we've just come off that 118.30 high, multi-year high. I've got a number of dotted lines in here, so hopefully not confusing. I've got short-term fibs in here with the 50-day moving average at 115.09. Then you've got a minor fib level at 114.39. I've got the high in here from April. That is at 115.72, which has acted as support briefly. And then if I pull this back, I've got long-term fib levels actually, but they don't help this move so much. So firstly, yeah, 118.30 is the high, of course. Initial support around 115.72, and then you've got the 50-day moving average. You can see as acting as support. That's at 115.09. We also have PMI data just briefly on Thursday. It should reveal kind of evidence around global growth momentum, supply chain pressures, hiring appetite, and also inflation risks. We get Australia and Japan kicking off, then, of course, France, Germany, Eurozone before the UK and US. Generally, though, I think composite PMIs for every one of these regions actually signaling modest growth above 50, essentially. Eurozone PMIs, manufacturing still below 50, but expected to tick up to 49.7. Services did drop below the 50 level in May, but is now above that. But of course, tariff headwinds loom. UK PMIs as well, some focus on those. Services nicely above 50, 52.9, I think, is expected. Manufacturing expected to rise to 48, and then the composite around 51.8. Certainly, there's been sort of some uncertainty just on the UK with that signing of the UK-US trade deal, but there is probably more uncertainty now about domestic matters. Actually, growing speculation about tax rises in the autumn budget, and there is, and we've seen that in sterling against dollar, obviously coming off, and then also euro sterling going higher, and you can see that nice, quite sharp upward bull channel there, series of higher highs, higher lows, really, and getting close to that spike high and year-to-date high at 87.38. And you just got recent highs just below 87. That's euro sterling. Okay, I'm going to wrap it up there. A bit longer than I hoped, but hopefully, yeah, really appreciate you guys all being and staying on the call actually for 45 minutes or so. Please do follow us on social media, lots of different channels. And also, as I mentioned, we do put out a daily commentary after the US close, as a look at the dollar, US stock markets, a look at the day ahead, and also a chart of the day. So please do try and look at that if you like, which is put on the website every day. Okay, take care out there. Quite a lot happening, really, with tech earnings, of course, and then that ECB meeting, always potential volatility around that. And of course, those earnings, as I say, after the US close on Wednesday. Thanks so much for being with us, and we will speak to you same time next week.